Welcome to Yahoo Finance Live. I'm Shauna Smith alongside Dave Briggs. We got just about an hour to go in the trading day as we wrap up what is a shortened holiday trading week here. You had the Dow off just about 16 points, well off its lows of the session. S&P and Nasdaq holding on to gains here, with the Nasdaq up just about 0.7% in terms of where we are seeing the leadership in today's trading action. We're looking at communication services, the outperformer there. Technology also among the winners today. Weaker than expected jobless claims rattling some investors. That's why you can see the Dow moving to the downside this afternoon. Of course, all eyes are on that jobs report tomorrow in March. We'll see what that will be, and we'll tell you what you need to be watching for.
And later, Costco shares are falling after posting disappointing sales numbers. We'll talk to an analyst who still has a buy rating on the stock in the next hour. But we start with some housing numbers. Mortgage rates have been dropping for 4 straight weeks. Home buyers, though, still struggling with the housing market. Here to explain is Yahoo Finance housing reporter Rebecca Chen. Rebecca, nice to see you. So rates are falling. How low?
So the average 30-year mortgage rate has fallen to 6.28 from 6.32%. But even though there is a dip in mortgage rate, home buyers are still struggling with affordability issues. And this is because the rate drop is just not enough to offset the high housing costs. Many of the sellers that we are hearing is that they do not want to list their homes on the market right now. They have locked in a much lower rate at under 6%, and they don't want to sell their house and have to rebuy into today's environment. So what we are really seeing is a market gridlock between buyers and sellers because of the mortgage rates. A lot of the experts that we've spoken with, we asked them about, so what can we expect for this future year? And many of them just say it's hard to predict what will happen next in this volatile market because of job reports, inflation data, and the banking crisis. They really don't know what's going to happen. But what many economists are seeing is that they believe rates will stay between 5.5% to 6.5% in this coming year. So we are expecting rates to hover around that in the meantime.
Yeah, there seems to be some rush to judgment that it's going to go right back to 3. We've seen rates take 10 years to reach a new level in terms of that 3. So it could be at 5.5 a year from now. Inventory remains the biggest issue out there in housing, and no quick fix for that. Rebecca, thank you. Good to see you.
All right, let's get you up to speed on another big story of the day, and that's the latest coming out of Fed officials here. St. Louis President James Bullard playing down the risk of a credit crunch. Yahoo Finance reporter Jen Schomburger is here with the details. Jen.
Good afternoon, Shauna. That's right. St. Louis Fed President James Bullard says he doesn't think reverberations from bank failures recently could cause credit conditions to tighten enough to tip the U.S. economy into a recession. On a call this morning with reporters, Bullard explained his rationale revolves around his estimate that only 20% of bank deposits are leaving the system in search of higher yield, and that right now it's not clear to him that there will be much of a pullback on lending. He said as long as banks have enough liquidity and capital, it seems they would make those loans if they were good ones to make. Now, some have suggested lowering the interest rate on the Fed's reverse repo facility could encourage money markets that have been parking cash at the Fed to get a higher yield on the cash they've been collecting from would-be bank depositors, for them to send that cash to banks to try to get cash back into the banking system. But Bullard patting that down, saying, no, we don't have plans to lower the rate on the Fed repo facility. Now, Bullard pegs the odds of 85% that the financial stress is going to abate, and the Fed will need to remain more focused on fighting inflation. I did ask him about the JOLTS report, given that we've seen job openings drop to the lowest level in nearly 2 years. Bullard saying that he's not taking much of a signal from that report, that perhaps we could see the beginning etchings of a balancing out of supply and demand in the labor market, noting that if someone loses a job or decides to move jobs, it's very easy to find another job in this environment. Back to you.
All right, thanks so much, Jen. Well, the Fed certainly still has its eye on inflation, which we will get a clearer picture of when we get that CPI report next week. Here to tell us what he thinks is ahead, we want to bring in Scott Ladner, Horizon Investments Chief Investment Officer. Scott, it's good to see you. So let's start with what we just heard from James Bullard earlier today. He's not worried about a credit crunch. He thinks that the Fed should stick to raising rates in their fight against inflation. What's your reaction to that?
Well, look, I mean, I think he's largely right. I mean, we've not seen any sort of contamination or contagion effects stemming out of some of this deposit flight that we've seen out of the regional banks. And there's a pretty simple reason for that. Regional banks don't really do business with each other. They do business with consumers. And so, the thing that caused all the contagion, all the problems in 2008 was that, the large banks traded with each other and they had a lot of sort of interconnectivity amongst them. That's just not the case with how regional banks act. They're more like a buffer system to the financial economy. And so, we think he's right in that, there are probably going to be some losses. There may be a couple more failures, but we do think it's going to be end up being isolated. And we do think we're going to kind of get through this reasonably unscathed with respect to sort of the broader economy.
Would love to ask Mr. Bullard about regional banks who do a ton of business with commercial real estate, and that could be a major issue ahead, Scott. What could that lead us to in this economy?
Dave, you're right. That is the bulk of community banks or kind of regional banks' business. They do tons and tons of commercial real estate lending because they operate in the local markets and they understand sort of like the local dynamics associated with commercial real estate lending. But there's one thing there's a big difference between commercial real estate lending and residential real estate lending, and that is basically the amount of cushion that that banks require purchasers of commercial real estate to put down. So it's not unusual to see between 20 and 30% down on a commercial real estate deal. That obviously was not the case back in 2006, 2007, in the lead up to the financial crisis, when we all these liar loans and kind of no money down deals. There wasn't any cushion. There wasn't any sort of room for error in that market. There's a lot of room for error in the commercial real estate market. Not only down payments, but we've seen a lot, tremendous appreciation in commercial real estate the last 3, 4, 5 years. And so the combined effects of that appreciation of the asset values, plus the money down that buyers had to take, to put in to the deal to even get it done in the first place, does give these banks, a fair amount of cushion with respect to the asset values relative to the loan values outstanding. So, while we could have a liquidity mismatch if banks end up having to take some of these properties back, we don't think it's going to end up being any sort of cascading fast-moving effects. And so, I wouldn't say that there's going to be zero problems emanating from the commercial real estate deals, but we don't think it's going to lead to anything really, really material in the broader economy because of those effects that I just mentioned.
So, Scott, how risky should investors be right now, given the fact that maybe the pullback that we were very worried about is not going to be as bad as maybe it has been feared? Is it time to add some of that risk back into your portfolio?
Probably a little bit slowly, Sean, because there is still there's one sort of hanging chat aspect with respect to what needs to happen in order for investors to feel really comfortable taking a lot of risk again. And that is the market's expectation for volatility of interest rates. So, for instance, the interest rate market, the interest rate option market right now is still pricing the 2-year interest rate in the U.S. to move like 10, 12 basis points a day, which is frankly just kind of insane for the world's risk-free asset. And so until or unless that number comes down to something more reasonable, like 3 or 4 basis points a day, until we get some clarity around what interest rates are going to be in the U.S. and what the risk-free rate is going to be in the U.S., it's really tough to get super aggressive on the risk-taking aspect. And we think that's probably going to change and probably going to come down as we get into late spring, early summer, as we get some more clarity around the Fed and the Fed's pause that we think is imminent. But until we get to that sort of clarity on what are rates going to be, it's pretty tough to get very aggressive on the risk-taking side. But we think we're getting close.
Yeah, as you point out, a lot of gray between what the markets are pricing in and what the Fed is telling us. Who do you think will end up being right when it comes to hikes?
Well, look, usually the Fed takes what the market will give them. And so, one of the reasons why they hiked last time is because the market had priced in that 25 basis point hike. Right now the market is sort of split. It's kind of a coin flip between whether the Fed will hike in May or not. We think that they probably will, but again, that's a pretty weakly held view. As far as the cuts that the market is pricing in for the back half of the year, we'd probably be a little bit hesitant to embrace those aggressively. We think the Fed would probably like to get to a pause, sooner rather than later, because policy is very restrictive. But we don't think they're really anxious to cut unless we see a lot of weakness in the economy. And we think we're going to see some weakness in the economy, but not probably enough to get the Fed to start cutting rates aggressively the back half of the year.
Scott, lots of focus has been placed on the bond market. More and more investors are saying others need to take a note of what is going on in the bond market because the bond market has been signaling that a recession is coming or that a recession is here. It sounds like you might not agree with that. What's everyone missing?
Well, the thing that they're missing, Shauna, is that usually if an interest rate curve is pricing in a recession, you basically see two humps. You'll see the first hump being, hey, listen, the Fed is going to, they hike too much. And there's a hump going up, and now they're going to have to start cutting, and they're going to have to cut aggressively because they've caused a recession. And then the next hump comes after the Fed is cut to below neutral. Basically cut interest rates a lot. Then interest rates have to come back up, back towards where neutral is, and so you kind of get this S-shaped curve in the yield curve. That's not what the yield curve is pricing right now. The yield curve is pricing right now that the Fed is basically about done, and then they're going to cut slowly back down towards their neutral kind of 3% rate over the next couple 3 years. And so, that pricing of, that shape of an interest rate curve is really more consistent with a, kind of a soft landing or maybe a mild recession than it is any sort of hard landing or sharp recession where the Fed has to cut aggressively and then slowly raise rates back up after the recession has passed.
All right, Scott Ladner, Horizon Investments. Good to see you, sir. Enjoy the weekend. Let's do a quick check of the markets now, sponsored by Tasty Trade. That whole setup that Scott left us with leaves us with these numbers from the market on a shortened trading week. This will do it. Not a lot of movement. Everyone hovering around the level mark for the day. The Dow down just a bit. The S&P up just a bit, and leading the way to the positive is the Nasdaq up 80 points. That's sponsored by Tasty Trade. We are just getting started here on Yahoo Finance Live. Still coming up, economists expecting monthly job gains to slow in March. What does this mean for the Fed's path for rate hikes? We'll get Conference Board senior economist Frank Steamer's take on what he's expecting ahead of Friday's jobs report. And with Easter, Passover, and spring break travel all falling around the same time, this weekend is shaping up to be very busy at the U.S. airports. We'll find out how flyers should prepare for the hectic travel weekend. Stay with us. Initial jobless claims and job openings data out this week, both coming in cooler than expected, with Thursday's data revealing 228 jobless claims in the month of February. Here to discuss the state of the job market on the heels of this data and ahead of Friday's jobs report is Frank Steemers, a senior economist at the Conference Board. Nice to see you, sir. Given the numbers we've seen, what are your expectations for tomorrow's pivotal jobs number?
So my expectation is still to look at the non-farm number. Overall job growth, of course, starting this year was very, very strong. First 500,000 jobs in January, then 300,000 jobs in February. I expect to see some moderation going back to maybe 200,000 jobs being added to the economy. Still keeping in mind, though, that 200,000 jobs, when we were talking before the pandemic about such a number, we would be very happy. It is still higher than the average of 2018, 2019. So overall, still a robust jobs report.
Frank, where do you think we'll see those gains? What sectors?
So over the last couple of months, we have seen, especially in leisure and hospitality, and also in healthcare and social assistance, that they have been adding most jobs to the economy. When we think about leisure and hospitality, of course, it's one of the very few sectors that hasn't returned yet to pre-pandemic level. So there still seems to be some pent-up demand. But especially the increase in healthcare services and the jobs that have been added there to the economy, that has been going at a very rapid pace. Of course, we have a US population that is rapidly aging. Of course, they require a lot of more healthcare services. So I expect that trend will continue. Retail trade also has been adding more jobs than I had actually expected. We saw some weakness during the holiday season, less upstaffing, but last month they also added many jobs. So I expect to see a similar picture also tomorrow.
We have seen layoffs pick up, and you lay out the sectors that are most in danger of layoffs as we move forward. What are those and why?
So let me first talk about layoffs in general. I know there have been many headlines, and I think many companies are indeed making announcements about layoffs. However, if we still look at initial claims for unemployment insurance, yes, it is a little bit higher after these revisions of today. Still, they remain very low. So if you compare them to before the pandemic, still, we don't see really widespread layoffs. If we do think about where are we going to see layoffs, which industries are going to be most at risk, it's going to be the information services sector, very tech heavy. We have already been seeing some employment declines over the last few months. In addition to that, actually, since October, transportation and warehousing has also been on a slight decline. We expect that to continue. Transportation and warehousing, of course, was adding many jobs shortly after the outbreak of the pandemic. There was a lot of consumption for goods. Many people wanted to have online services, were ordering a lot of stuff. Now, of course, with the economy changing its demand more towards services again, we do expect that also that sector is likely going to show softer hiring.
Frank, what factors did you use to try and determine the likelihood of job loss and what sectors we were going to potentially see them?
So there are, of course, many factors that go into understanding where job losses are going to happen. I think one that is very important is where are the labor shortages? If an industry has many labor shortages, probably these employees will be more careful about laying off their workers because they know, especially if a recession is going to be just short and shallow, if the economy starts growing again, they have to rehire those people, and it can be very difficult and expensive, as the last 2 years have been showing. Probably also very important is how sensitive some sectors are to interest rate increases. We know that especially the housing market has a big impact on construction. So, for example, construction is very dependent on what is happening to interest rates. So also there we expect to see some weakness. On the other hand, if you think about healthcare services, education services, much less cyclical, so much less impacted by interest rate hikes. And then lastly, just the trend that we have seen after the pandemic, some sectors probably overhired, again, transportation, information, and some other sectors like leisure and hospitality is still below pre-pandemic levels, so there will be less need for layoffs.
And leisure and hospitality, you think we'll continue to see the gains we've seen in recent months, and does it lead the safest sectors?
So I would say that leisure and hospitality will continue to add some jobs, probably not anymore as rapid as we have been seeing over the last couple of months. The closer they get to pre-pandemic level, the closer they get to full staffing again, So also then when they're at full capacity again, there's simply less need for hiring. We are already seeing that in other sectors. But since it is still one of the sectors not back to pre-pandemic level, also one of the sectors where labor shortages are probably the most severe in those in-person services industries, I expect that leisure and hospitality, weirdly, if you compare it to the COVID-19 recession, they were the hardest hit. But this time they will actually maybe get out of a shorter and shallower recession in a much better shape.
Frank, what are you seeing just from the consumer? Because your latest data out on consumer confidence showing that it actually ticked up in March. And this was after the fact that we saw some turmoil in the banking system, lots of fears about contagion, what that could potentially look like. How would you characterize, or what are you seeing in terms of trends right now with the consumer, and whether or not you expect that to continue?
So when we look at the consumer and how they are looking at the labor market, they're actually pretty positive. When we look at the consumers saying, are jobs hard to get? Most of them are saying, no, it seems that jobs are really plentiful. On the other hand, there's of course some weakness in the economy, and especially inflation has had this impact on the expectations in consumer confidence. I think as long as actually the Federal Reserve continues to raise interest rates, signaling that they do want this economy to slow down, as long as inflation reports will be coming in, that this will also have an impact, of course, on how confident the consumers are about the next months in the U.S. economy.
All right, Frank Steemers, always great to get your perspective. Thanks so much. Have a good weekend. Well, coming up, L'Oreal making its biggest acquisition ever, buying a well-known skincare brand in a $2.5 billion deal. What this tells us about the luxury market and its consumer when we come back. Let's do a quick check of the market sponsored by Tasty Trade. You're looking at a mixed picture here with the Dow in negative territory, although well off its lows of the day, off just about 41 points right now. S&P and Nasdaq trading to the upside. You're looking at the Nasdaq, the outperformer in today's action, up just about 0.7%. Let's get to some big M&A news. French cosmetics company L'Oreal has struck a $2.5 billion agreement to buy Australian luxury beauty brand Aesop. For more on the deal and what this tells us about the state of the luxury consumer, we want to bring in Pauline Brown, former LVMH chairman of North America and also author of Aesthetic Intelligence. Pauline, it's great to see you here. So this deal here from L'Oreal certainly marks a shift in terms of their M&A strategy. They normally target some of those smaller brands. What do you make of this and really what it tells us just about the growth potential that they see in Aesop?
Yeah, well, first of all, it is the biggest acquisition that L'Oreal has ever done. L'Oreal's done a lot of acquisitions over the years. But it's actually not a very big company next to the size of L'Oreal. So it's, very affordable vis-a-vis the total size of their revenues and portfolio breadth. This is a great business. It was a great deal. It was a competitive process. There were a lot of companies and private equity players that would have loved to get their hands on this brand. I might argue this was one of Australia's biggest success stories in the consumer branded world. And why did L'Oreal want to pay such a premium? Because it is probably in the order of a mid-teen multiple in terms of the 2.5 billion price tag vis-a-vis a profitability and EBITDA margin of somewhere between 150 and 200 million. So it was still a healthy price, but I think it was a great brand, a great business in terms of its top and bottom line, and a great positioning for the world that we live in, which is all about sustainability, which is all about what Aesop cares about.
Nice to see you, Pauline. And you talk about why they made this deal. How does the potential to enter the China market factor in?
Well, I think that was another growth opportunity for L'Oreal. As you might imagine, China is a huge market for L'Oreal. It's a huge market for every beauty player, but particularly for the big consolidated ones. And in the case of Aesop, they had just entered it last year, just entered China. So they're very late to the game. But with the support of a global player like L'Oreal, with the ability to plug into L'Oreal's infrastructure, I think they're going to see a huge wave. And I do think that their positioning would lend itself well to some of the trends we see happening on the ground among Chinese consumers.
Pauline, what do you also think that this maybe potentially tells us about these smaller players getting acquired by the larger players? When you look at L'Oreal, when you look at Estee Lauder, do you see this type of M&A continuing within this space?
Yeah, well, first of all, there are very few high-quality, mid-size independent assets in beauty and in most areas of design-driven consumer brands. So there's a scarcity of assets. Estee Lauder, has been on that track to buy up relatively small brands for now 25 years. I was part of the team back in the day that did their acquisitions. This one is not so small next to some of the deals I worked on. When I was part of the team that acquired Joe Malone for Estee Lauder, it wasn't even doing 20 million in sales, and Aesop is north of 500 million. So I wouldn't call it a small business vis-a-vis the industry. It's small vis-a-vis L'Oreal. I would call it a very solid and high-performing mid-tier, mid-size. And yes, I do think there will be others if the others are performing at the level that Aesop has for many years.
Interesting. And industry-wide, cosmetics, are they recession-proof? Talk about the potential growth that lies forward.
So in general, beauty has outgrown all categories of consumer goods for as long as I can remember. And premium segment of beauty even outgrows the total market of beauty. And I would put this in the premium segment. There are other categories like ultra luxury, the companies like Chanel and Hermes, and some of the LVMH brands that have grown even faster than the likes of an Aesop. But I would say what is interesting here is beauty has been relatively robust. It has obviously during the pandemic moved largely online. Aesop is about 30% online penetration in terms of its total sales. But more importantly here, it has way outpaced the growth of the total beauty sector. And I would say it's probably outpaced almost all of the L'Oreal brands in terms of its recent performance, top and bottom line.
Pauline, just give us a sense of the luxury consumer, because we were saying for months and months and months that the high net worth individual was really fueling the sales of those luxury brands. They weren't worried about or affected so much by inflation. They weren't worried about maybe an impending recession. Is that still the case, or are we starting to maybe see a little bit of a shift?
We are still seeing very robust sales in the luxury market. What I will say, just segueing from Aesop, is it really isn't a ultra wealthy consumer that's buying Aesop, or for that matter, most prestige beauty brands. That is a much more democratic marketplace than, say, an Hermes or Chanel that I referenced earlier. But what we see across the board is there is still general strength. Some segments of luxury are benefiting more than others. So, for example, in fashion and accessories, a lot of the boom is coming from Asian and American travelers in Europe. In fact, that is now shifting sales. What was happening at home is now happening abroad. So where people are spending and some of the categories they're spending on is shifting. Travel's been a big beneficiary, but I don't see wealthy consumers pulling back meaningfully, especially as you go into the sort of top 5% of the socioeconomic ladder.
No sign of that whatsoever. Pauline Brown, nice to see you. Thanks so much. All right, coming up, Walmart embraces an EV future. Shares of the retailer edging higher as the company plans to add thousands of electric vehicle charging stations to its stores. We'll tell you about that on the other side of this break.
It's time for our triple play. Three stocks that we're watching here in the final half hour of trading. We've got Walmart, Levi's, and Comcast. Kicking off with Walmart. Now, the retailer adding thousands of EV charging stations to its stores, expanding its current footprint of 1,300 EV stations at 280 stores. Now, Walmart didn't give many details about the suppliers, who they are going to work with when installing these EV charging stations. But right now, they have currently worked with EVgo and also Electrify America in the past. Big picture, though, this could maybe help EV adoption. We know there certainly is some range anxiety, and there's a Walmart store or Sam's Club within 10 miles of about 90% of Americans. So more access there potentially to some of these charging stations. EV sales accounted for just 7% of all U.S. vehicle registrations in January. So Josh, the lack of charging stations is just one of the challenges here, just in terms of main widespread adoption of EVs. So Walmart being one of the first, or one of the biggest, I should say, retailers making this push into installing some of these charging stations.
Probably a trend that we're going to see, right? Because I think specifically with Walmart and Sam's Club, it just makes a lot of sense. Because one thing I know I've personally thought about when it comes to charging is I don't want to sit there while it charges, right?
Yeah.
And people will hopefully have them, as Dave fumbles here. Maybe we'll charge up later with the hot sauce. But I think it's interesting to think about how you're going to charge these. And obviously Walmart or Sam's Club lines up well because that's a store you go into for, say, maybe 30, 40 minutes. You're doing a long grocery run and a lot of shopping in there. So it gives you time to kind of properly charge up. I'll let Dave deal. Or Dave, do you have a comment on the charging stations?
Yeah, I will. I was at the New York Auto Show yesterday, and I will tell you, every single automaker I spoke with, every single writer and blogger said that the biggest single factor in mass adoption for EVs is the lack of charging stations. And the important thing about Walmart is not just how many they are, but where they are. They're in rural America where there's no chargers. Essentially, all the chargers in this country are Los Angeles, San Francisco, and some in New York City and Austin, Texas, where Elon Musk has taken Tesla. But really, the entire middle section of this country is void of chargers. So this is a huge development for the industry, even more so than it is for Walmart, probably.
Yeah, certainly.
Probably be a battle for those chargers, though, right? When there's only a couple. In
No
there.
question.
Yeah, it depends how many there are at each store. Yeah,
But again, to your point, we're still only at 7% in terms of EV adoption.
My play today is Levi's, and those shares are sinking, on pace for their worst intraday performance ever. Inventory increases continue to lag on the stock. Inventory for the first quarter rose 33% on a yearly basis. That came in above street estimates. Levi's management noted on today's earnings call that the company expects levels to be in line with sales growth by the end of the year. Now, Jim Duffy at Stifel points out Levi's had initially guided for inventory in line with sales growth in the second quarter of this year. So Duffy notes that inventory is still an overhang, but Levi's did beat on the top and bottom line today. So maybe some upside in the long run. But I do think, Dave, that inventory probably weighing on margins and potentially building up an issue there for Levi's.
That was my lead when reading this. Now, they did 12% growth in direct-to-consumer, but my lead here was the margin compression, 360 basis points in that regard, and that is a really tough number to swallow for investors.
Yeah, it certainly is. And even when you look at that sales number, their sales, we saw some improvement, but that margin pressure really points to the fact that promotions, they were forced to promote so many of their sales here over the last quarter, something that many of its competitors out there have had to do because people are really pulling back on spending.
Indeed. All right, my play is Comcast, owner of Universal Pictures. That's the studio behind the new Super Mario Brothers movie in theaters nationwide today.
There's a huge universe out there with a lot of galaxies. They're all counting on us. No pressure.
Man, I think it looks really good. Mario, Princess Peach and company teaming up, though, with beloved sauce brand Truff to drop a limited edition collectible pack of its truffle-infused hot sauces. The pack features Truff's 3 best-selling sauces in this exclusive Mushroom Kingdom VIP gift box. These things are selling like hotcakes. They've become incredibly popular. I want you guys to try. I will tell you, it is hot, hotter, and then white truffle infused. So let's start from the right, and then we're going to go.
Have you tried this yet?
I have not tried it yet.
He's just facilitating this time.
I will
After all the
try
hot
it. I will
sauces.
try it. But my kids are obsessed with this truff sauce. They have a lot of partnerships. They have one with Costco. You can get it there. It's doing so extraordinarily well. Hot sauce combined with truffle, right? Two of the real popular things in this country. I should mention the Comcast stock, by the way, is down fractionally, though, up 6% this year. Why is it down? It may have more to do with a note here from Morgan Stanley Wealth Management. They sold their Comcast shares, citing a company with, quote, no clear catalyst. I'm going to try it. What do you guys think?
It's very hot, but I think it makes so much sense for this company. You're right. This sauce really has a cult-like following almost, I would say. They capitalize on a lot of these types of promotional activities, and this makes so much sense. You're really tapping nostalgia with so many people out there who are excited for this. In terms of that, it's too hot for me.
It's really hot.
It's really hot.
I think
That's
it's
the
good.
extra
I think
hot
it's good.
one, and that's a lot of sauce.
That's the hottest one in the middle?
Yeah, I only had the middle
you
one, the
told me
hottest
the
one.
right
I thought it was
thing.
good.
It's delightful.
I think it really does build on to what we talk about all the times when once you get these universes, having a movie, building products out of it, it makes sense, right? You could see Mario lovers maybe even getting one of those and not opening it.
Yeah.
It's got a fun cover on it.
I got a question though. How many people are really going to go and see this? You said you love the trailers. Would you go and see it in theaters?
Well, you know what I'm going to see in theaters? Air.
Barbie. Oh.
Air, which we will talk about later on. That movie I'm really excited for. I think it's probably a younger demographic than the 46-year-old.
To me, I think it is more appealing the other way, where you have a movie and then build a video game off of it. I always liked playing those games growing up, like a Harry Potter video game or the Star Wars Legos that they came out with. I love that series, and it worked for me that way. I don't know if it works when you go video game to movie as much for me. I should know I wasn't that big of a gamer growing up, but I just casually played video games, so I think it's more probably for that hardcore Nintendo style audience.
Yeah, I grew up on Super Mario Brothers. The hotter is the one closest to me.
You're starting to sweat a little bit.
It is on fire.
Really on fire.
I prefer
but
the
it's
white
good.
truffle infused.
The truffle's the best tasting one.
Smart move by them. All right, guys, we got to
Nice
leave
collab.
it there. But coming up next, mastering your last few years before retirement. It can certainly be tricky. Well, our next guest is going to break down what you need to consider in the final years before you retire. Next.
Are you retiring soon? If so, and you're planning to do so within the next 5 years, our next guest, Investopedia Editor-in-Chief Caleb Silver, says there are some important things you should look into. He joins us now for this edition of Retirement Ready, brought to you by Fidelity Investments. Good to see you, sir. Let's start with just step one. What's the first thing I need to know if 5 years out I'm retiring?
Yeah, but big, broad look. You have to be the CEO of your own life, of your own personal finances. So we ask people to make sure they know what their income replacement strategy is going to be. How much do you need? What does it cost to be you now? What's it going to cost to be you in 5 years and beyond? Because we know we're living a little bit longer. Retirement is not just 10, 20 years anymore. It could be 30, 40 years. So what's that replacement cost? And then how are you going to fund that? Is that from your savings? Is that from your investments? Do you own other properties? What's your income strategy while you're doing this? Or are you just drawing down from your retirement funds?
And Caleb, you also make some points here. You need to be tax aware and also properly insured. Walk us through what exactly people need to consider when they're factoring in those 2 points.
A lot of people have been saving for retirement. They've been investing for retirement, but they don't know if they're in the right tax strategy in terms of long-term capital gains, in terms of what's taxable, what's not. A lot of folks aren't aware of that. So you have to know that, and you have to set aside that money for insurance, especially if you have a family. You want to make sure you're covered. You want to make sure your family's covered. And when you go through that checklist, whether you do it with a financial advisor or you do it online through a digital advisor, you have to check all those boxes to make sure everything is covered, because you want to be covered and you want your loved ones to be covered as well.
Should you be rebalancing your portfolio, and if so, how?
Yeah, this is a time to get a little bit more defensive, especially if you have a kind of a risk lean into your portfolio. You want to lean back, play some defense here. We're talking about fixed income. We're talking about CDs. There's finally money in the bank, guys, 4 or 5%. So we're talking about that type of thing, money market funds. We also want you to also be aware of what's taxable and what's not within that strategy, because as you start drawing down, whether you're taking down 4% on that 4% rule, make sure you know the tax implications of doing so, and then pad your savings a little bit. These emergencies come up all the time. The last few years have taught us a lot of lessons. You want to have a little bit more savings, especially as you're going into that 5-year stretch.
And we also talk about having enough savings there. A lot of that has to do with right sizing your balance sheet, really figuring out how exactly you should be budgeting moving forward. What are some of the things that people need to do or consider when they're trying to get the best grasp on that?
Yeah, you think about the percentage of income you're going to need, or the percentage of expenses you're going to be able to have to reduce to live the life you want to live. So if you haven't mapped out yet what that retirement plan looks like, where are you going to live? Do you need a big house if you own one? Do you need to have room for other people? So you have to have that in mind, and you have to have that retirement plan automated. That means paying yourself, as we always say, but also making sure that you can see everything, whether it's on a spreadsheet, whether you're working with a financial advisor. Financial planners and advisors are great at this. Make sure you're aware of that, and then track your goals. Meet quarterly on that with your family, with your partner. Where are we on the path to retirement? Because it gets tricky as you get in there. It's not just you flipping off a switch and not taking income anymore. Paying for that on the way down as you ease into retirement, super important, and then expect the unexpected, because we know things happen.
What's the most common mistake people are making?
They think that they've had enough saved for retirement, or they haven't really calculated that drawdown. We usually talk about a 4% drawdown to pay yourself, but if you haven't done the math on what it costs to be the you want to be once you get into retirement, you could be very sorely mistaken on how much you're going to need. And what you also don't want to do is go in thinking you have enough, but you really haven't done the appropriate planning to know if that's true or not. So it's those expectations that you think it's going to be all right, but really not knowing the numbers.
Excellent advice. Caleb Silver, good to see you, sir. Appreciate all that. Okay, coming up, Pfizer's RSV vaccine showing some promise in late-stage trials. We'll have the details on the other side of this break.
As we head into bank earnings, there's a phrase you're probably going to hear a lot of. It is net interest margin. So we want to tell you exactly what that means. It's the difference between the interest that a bank pays out and what it brings in. So in other words, a bank takes in deposits from you, from companies, and it pays interest on those deposits. So that's the money that it pays out. Then it also loans out money to you for your home, for example, to businesses, and then it collects interest as a result of lending out that money. The difference between those two numbers, that is commonly referred to as net interest margin. So in other words, if I'm depositing my money in the bank and collecting 3% interest on that, and then also if I am borrowing money from the bank for whatever it may be, and I'm paying 7%, say, on that loan, the difference between those two, 4%, that's the net interest margin. But to get a little wonky for a second here, the technical definition then takes that number and divides it by the average earning assets at the bank. All that means is all the other stuff on the balance sheet that doesn't really move around that much, stocks, bonds, etc. That's where you get the net interest margin. It's also especially relevant right now with a period of rising interest rates. Why? When interest rates start to go higher, more people want to put their money in savings at the bank because they're getting actually some interest on that for the first time in a long time. And maybe fewer people want to borrow money because it's more expensive to do so. So it's particularly relevant right now, and we're going to hear a lot about it once the banks start reporting.
The New England Journal of Medicine says there's promising data from a late-stage trial of an RSV vaccine being developed by Pfizer. Yahoo Finance's Anjali Kamlani here to break it down for us. Hi there, Anj. What are we learning?
Hey, Dave. So we know that Pfizer's RSV vaccine protecting against RSV for infants, especially when it's given through pregnant mothers, has proven 82% effective in a phase 3 trial. That's a really good number. It kind of is on par with what we saw with GSK, which is another player in the field, but we'll get to that in a second. So phase 3 trial, the trial was conducted in 18 countries with pregnant women who were between 24 and 36 weeks pregnant, and this is for a single shot, so that's really good news as well. Pfizer also has developing a vaccine for older adults. And that's another area where we've already seen the FDA advisory committee come in on that. So let's look at the vaccine race here for RSV, because that's where the new vaccine race is. You've got GSK and Pfizer both really in the lead here when it comes to being in touch with the FDA and having advisory committees already for their older adult vaccine. We also know that Pfizer now has the infant one. Also, Moderna in the race got a breakthrough designation from the FDA. So those three are kind of the ones that are ahead of the game there. And then we've got Johnson & Johnson and Novavax, which in various phases dropped out or have paused their trials. So that's sort of where we are. Three leaders in the race right now. Important to note that RSV, while it has been around for a while, there is no vaccine for it just yet, either for infants or older adults. And it is particularly, important to for those individuals because it's kind of deadly for that age group. Most kids do get RSV by the time they're 2 years old, but we did see quite a harsh season last season, especially with the triple-demic. So that's where a lot of focus is on this infectious disease right now.
And just the FDA right now saying some Americans may be able to get their next updated booster soon, something that they want to get out there so those booster shots are not wasted. What can you tell us about that?
That's right. So this is the second booster of the Omicron-specific vaccine for COVID-19, and that's going to be largely for the most vulnerable population. So you're thinking older adults, immunocompromised, and that is something that the CDC is going to likely allow but not recommend. So that falls in line with what we've seen, with the administration sort of pulling back from the emergency situation. And it's important to note that we're currently dealing with a new variant, sort of in that same family, though, the XBB.1.16. That's the one that the World Health Organization is currently focused on. There have been cases reported in 18 states here in the U.S., but it is largely doing a number really on Asia and the Middle East right now. So a lot of focus there. Some of the countries there are masking up once again as a result. So something to keep an eye on for sure.
All right, Anjali Khemlani, thanks so much for that. Coming up, we are counting down to the closing bell on Wall Street. Again, the Dow in negative territory, off just 21 points right below the flat line. We'll be right back.
All right, we're just a few minutes away from the closing bell for the week. Let's bring in Yahoo Finance's Jared Blickery to break down the market action. Hello, sir.
Hello, and we got mostly green over here. You can see the Dow down 1 basis point, might flip in the final seconds here. But for the week, let me just show you what's been going on. Dow actually ending in positive territory for these 4 days. And tomorrow morning, we're going to be here front and center. But guess what? The regular market's going to be closed. We do have the bond market open tomorrow, as well as stock futures for a bit. So make sure you turn in here. But Nasdaq down 1% over these 4 days. And let's take a look inside the market. Pretty interesting what's happened. We have a really defensive setup for most of the week. Communication services is up over 1%. That houses the mega caps like Verizon, as well as Netflix, as well as Meta. So kind of a hodgepodge there. Utilities, real estate, and tech, those round out the outperformers. For the week, though, you take a look at what's been leading. XLU is utilities, then healthcare, energy, consumer services, communication services, and staples. So looking pretty defensive there. Industrials and consumer discretionary, that's retail. Those sectors unloved this week. Let me shift it over to our leaders and see what's happening today. Meme stocks not in favor. That's down 3%, that ETF. Cannabis, that's taken a hit recently. That's bouncing up today, but not a lot of big leadership in terms of some of our fringe markets. And then you take a look at what's happened over the last 4 days. All of the fringe markets have been seeing selling this week, along with the Nasdaq. So maybe a reversal in play of that strength that we saw over the fourth quarter. Let me just show you the regional banks here while we got a few seconds left. Lots of green here. And then we're going to talk about energy. Contrast that with all this red, guys.
Thank you, sir. And there is your closing bell for the week. Yes, it is a shortened trading week, but a reminder, we will be here tomorrow morning to get that jobs data. Don't you worry, Shauna Smith has you covered for those pivotal jobs numbers. Let's check out how we finished the week. The Dow just barely eking out a gain in the last few moments, and the S&P also finishing in positive territory. And once again, the tech-heavy Nasdaq continues to outperform, up about 3/4 of a point, just shy of 100 points. That's brought to you by Tasty Trade.
All right, let's take a look at some of the individual movers of the day. First up, we got to take a look at Airbnb. This stock on the move here, closing off almost 5% here. Now the move lower coming after a short report from the Bear Cave Substack arguing that Airbnb's top hosts are building out rival booking platforms and are now directly competing with Airbnb for business. Airbnb has not responded to Yahoo Finance's request for comment. Now the stock was off nearly 7% earlier in today's action, and a little bit of a recovery, I guess you could call it here, for Airbnb in the final couple hours, Dave, because some on the street taking issue with this report.
Yeah, it does appear, though, that investors, for the most part, do buy it. But Bernstein pushed back today, saying, quote, "We want to make clear that professional hosts are actually property management companies that come in as additional layer in the private rental ecosystem." I just want to add, look, it seems inevitable that trend probably would happen, that some of these Airbnb hosts would start their own platforms and begin to lower prices, but it's all about scale here, right? You're not going to get the scale ever that Airbnb is. How are you going to track the type of numbers that you're going to need? This is a fractional dent in their numbers. Surprising to see it drive the stock down so low. All right, Levi's shares closing out their worst intraday performance ever as the retailer's inventory continues to remain high and the company's quarterly profit declined from the same period from a year ago.
Yeah, and Dave, when you take a look at this name, I mean, it's pretty incredible to see today's drop off just about 16%, the biggest drop that we have seen there. Inventory levels, obviously still an issue here. They are still high, but we are seeing a little bit of an improvement in terms of also digging into these numbers. The company did have better sales, but those lower margins, clearly an issue here for the street. Promotional activity obviously playing into the result that we did see Levi's likely forced to discount maybe a larger portion than they had initially anticipated of some of their merchandise in order to clear it from the shelves and try to get a better handle on those inventory issues.
Boy, that is a huge drop when you consider the numbers don't appear that bad, at least on the surface, though. The margin contraction related to the inventory issues, 360 basis points. Interesting point from their CEO in the call, says Bad Bunny was a huge catalyst for them, wearing vintage 501s to kick off the Grammys. 3 billion impressions globally for that video. Some classic 501s from Bad Bunny.
There you go. All right, well, finally, AMC's settlement to convert APE shares into common stock has hit a snag. A Delaware judge denying the company's plan for the stock conversion, which also includes a 10-to-1 reverse stock split. Now, the news sent AMC shares soaring by over 20% today. Remember, it's only $4.90 here. APE shares, though, you can see under pressure, off just about 11%. Obviously, a reversal from what we saw earlier in the week, Dave.
Yeah, it kind of predicted. We saw this coming. These two will continue to converge a little bit. And at some point, we will return to talking about AMC's core business, which, of course, is movie theaters. And their last quarterly report showed revenue down 15% year over year. But it looks like the movie theaters are seeing a bit of a turning point, certainly in this quarter. When you look at the numbers from Creed 3, from John Wick 4, this particular weekend looks like a solid opening for Super Mario Brothers, for the Air movie from Amazon. So it looks like we are returning to the movie theaters, and the box office appears to be healthier than once thought.
We'll see whether or not that's going to help AMC shares here moving forward. All right, let's also get over to another big mover of the week, really, but you're looking at gold. Off a little bit today, pulling back from a 13-month high on weaker economic data. Still, though, obviously above 2,000. Gold since the start of the year up just about 10%, hovering above that critical $2,000 level here, and just trading just about $50 below its record high. We want to bring in Bob Iacchino. He's Path Trading Partners co-founder and chief market strategist. Bob, it's good to see you here. So we're holding above that 2,000 level. I think a lot of investors are asking if there's really upside here to the price of gold. What do you think?
I think there is. Gold was my big call for the year. I'm sticking with that as of this point. I still think we're going into recession, although the timeline may be pushed a little bit. The yield curve says we're already there. Economic data has kind of started to slow. And if you're long gold, which I am, the best case scenario is the Fed cuts rates to get you out of a recession, which is positive for gold. Worst case scenario, the Fed continues to raise rates. I think this is the least likely. And they hold the pause a little bit longer. 2 out of 3 of these cases is good for gold. The worst case scenario is that they hold the pause and we actually get this soft landing or easy landing or even no landing. That wouldn't be great for gold, and I think that's the least likely scenario.
Fed certainly plays a role. Bob, talk about some of the other factors driving the prices where they are today.
Well, again, you have this issue of asset prices being sold off, and gold has always taken advantage of that. And what's generally happened is the Fed, again, bringing that out, cuts rates to help the economy and help asset prices. That's been a driver of gold in the past, and a lot of people believe that. CME Fed Watch Tool has cuts starting in July of this year, which the Fed says they're not going to do. Another one is people think of gold as an inflation hedge, and it's really not. What gold is it's an asset. And if you look at assets in general, when inflation starts and then continues to rise through, gold powers through that because it's an asset. Just like house prices, just like stocks, we forget the good part about inflation is asset inflation, and gold is an asset. The problem comes in for gold investors when the Fed starts to aggressively fight inflation. So something we haven't had, which has contributed to gold's underperformance over the last decade or so, was we haven't had inflation, so we haven't had a Fed to fight inflation. And that's kind of gave gold this weakness. When inflation started, gold rallied. We saw that March spike that references almost the all-time high that Shauna mentioned. We're driving toward that again. And if we are in a situation where, as Neil Dutta from Renaissance or at Macro put it, inflation remains unaddressed, then gold's going to benefit from that.
Bob, how much upside is there to gold? Are we talking 2,500? Are we talking above that?
But here's what people think I'm nuts. I think we can easily break to new highs. And I think if it goes the way I think it's going to go, easily within the next 12 months, we could see 2,800. I used to say by the end of the year, I'm not saying that anymore because I think the Fed was much more aggressive than I thought they would be when I made that call. But I think the issue here is the popular opinion, and the politically popular opinion is that the Fed should stop trying to fight inflation. And I don't think people realize how bad that is for the whole country as opposed to just 2 or 3 million people. And I don't mean to downplay that. I want to stress that. But the 2 or 3 million people that may lose their jobs in a recession, as investors should look at it, is good for gold. Is good for stocks. It's not necessarily good for gold. Where gold outperforms is when there's inflation and a recession. And I think that's what we're going to, because I think the Fed is going to cave into pressure and stop fighting inflation.
2,800 call. Gutsy. All right, Bob, with that, we want to play a little game. We want to see how deep your love for gold goes. We're calling this Bob's Buys. We'll give you a choice between two investments. You'll tell us which is the buy and why. First up, Bitcoin, which has been surging with gold, which seems a little odd on its face. So Bitcoin or gold?
So I have to ask you a question first, and we actually did this with a recent guest on our podcast. Yeah. Is this 100% in one or the other?
Is it 100%? I'm not sure.
You mean all in on gold or all in on Bitcoin?
Yeah. Can I go 70-30 or I can't do that?
Oh, I see what you're saying.
Sure. You can make your own twist to the game. We're open to suggestions, Bob.
Well, right, look at you making up your own rules. All right, I was going to say 100%, but go.
Well, actually, if you make me pick 100, it's gold. I am actually in about 70% gold, 30% Bitcoin for that amount of the capital that we allocate to this sort of space. Because I think the issue with Bitcoin is it here in 10 years or not? I think it is, but I don't run that sort of part of the game. So.
All right, Bob. Well, we're setting you up here because we had a couple to get through. So the next one up is Treasuries tips or gold. What do you think?
Gold.
You're sticking with it. Didn't even have to think twice about it.
I want to get back to the prior answer. What do you make of the dynamic, though? Gold rising typically tells us people are risk averse. How does that rise with arguably the most speculative asset on the planet in Bitcoin? How do those rise together?
So Bitcoin has a couple of things going for it. It's again beginning to perform in a non-correlated way, which I like. It hadn't done that. It was correlated very sharply to the Nasdaq. That's not the case anymore, at least in the short term. If that sticks with it, then a non-correlated asset is always good in any environment. So that's really the core of it.
All right, Bob. And last up here, I bonds or gold? What do you think?
Wow, that one's tough. I'm going to have to say gold too, but I think if you put me in a position, I'd go 60% gold, 40% I bonds.
All right, there we go. All right, gold, the winner of all three. You're the gold guy, so maybe we shouldn't be surprised by that. Bob, great to see you. Thanks so much.
Good to see you guys.
All right, coming up, Costco shares take a hit after the company reports its first monthly same-store sales decline in nearly 3 years. But see why one analyst remains bullish on Costco next.
Shares of Costco closing the day lower, off just over 2% after the retailer reported its U.S. same-store sales dropped 1.5% in March. Now, that is the first monthly decline for the retailer in nearly 3 years. Here to dig further into these numbers, also talk about the retail space more broadly, we want to bring in Goldman Sachs equity analyst Kate McShane. Kate, it's good to see you here. So certainly the street taking some issue with the results that we just got here from Costco. Anything that you're worried about in these sales numbers?
Yes, I mean, it was a surprise to the market. I think the fact that things were a little bit weaker than expected. We had actually seen in February, too, a slightly weaker than expected same-store sales number out of Costco. And, you know, part of it has to do with the fact that we are now in year 4 of very strong sales out of Costco. So as you lap, you know, strong sales, it does become harder and harder to grow off that. So I think that's something that definitely has to be considered. I think the other piece too is that there's quite a few pieces of the business to Costco. There's the consumable side and there's the discretionary side. And the discretionary side includes big ticket items like consumer electronics and other categories like that, jewelry. And that's where the softer piece of this story has been. I don't think that is necessarily new news to the market necessarily, or even based on what the headlines we're reading, is that, you know, discretionary is a softer category right now for the consumer.
Nice to see you, Kate. It's a bit alarming, not just when you hear 3 years, but when you think about what was happening 3 years ago. That was the early months of COVID. So it sounds like alarm bells there. And Costco cites falling gas prices, foreign exchange in terms of their VP of finance. But is there any good news in here that perhaps food prices are falling and maybe that's a good consumer story, not investor in Costco?
Yeah, I think that's fair. I mean, we have to remember too, you know, there's a number that includes gas and then there's a number that doesn't include gas. And that number that doesn't include gas was still positive for the month of March. It was up about 1%. And the reason why you have to sometimes exclude gas is because there's just a lot of volatility in the price of gas, of course. And then, you know, in terms of what we are lapping, you know, gas prices a year ago were very high, and that resulted in Costco drawing a lot of traffic to their stores because they sold affordable, competitive gas. So that's something to keep in mind with regards to the comp. But to your question about what the good news is, I do think, you know, they were impacted by some decelerating inflation. We definitely saw that in both the fresh category and the food and sundries category. And that has been, you know, somewhat anticipated that as the supply chain starts to improve, that you will start to see some of these costs for the consumer to come down.
Kate, you've got a buy rating on the stock, 538 price target. We closed today right around 485. What's the biggest catalyst that you see for Costco in the near future?
I think what we're most optimistic about with Costco is all the signups and memberships that they have seen in the last 3 years. The club model is very attractive. And what I mean by the club model is you pay a membership fee and then you get very attractive prices on the goods that you can buy there. And, you know, what's so attractive about that is that we are dealing with a consumer that's dealing with still moderating, but still quite a bit of inflation, especially in food. And we do think Costco is taking share there. So we don't really see that changing. And then when it comes to the membership and the higher levels of membership and the higher amount of renewal, that's something that can compound over time. As the consumer learns more about Costco and becomes a more seasoned member, they will spend more. So I think the combination of just the model, Costco's execution, their bigger membership base, and the fact, too, that they are a global company, there's still a lot of room for them to open stores and grow, are why we remain bullish on the stock.
You're also bullish on Walmart, and they're in the headlines this week, 2,000 e-commerce layoffs, and we found out the next day why. 65% of stores they'd like to see automation by 2026. Tell us about the buy and why a price target of 164 and what you make of the automation report from Investor Day.
Yes, I think starting with the investment thesis, this is the most excited we've been about Walmart in quite some time. We've been anticipating since we put Walmart on our conviction list here at Goldman since October 2021 that we would start to see an acceleration in the algorithm. And what I mean by that is that we would start to see faster growth out of this company. It's been a very long time that you've seen kind of flattish to only slightly positive growth in operating income dollars for this company ex the pandemic. And a lot of that has had to do with the fact that they've had to invest in their business. They had to invest in wages. They had to invest in price. They had to invest in technology. And we're now at a point where all of those things are coming together and the company is able to capitalize on a lot of those investments. That, coupled with the fact that they're entering new businesses that are more profitable, just makes this story a more profitable story going forward. And we find that really exciting and a real change in terms of what we've been hearing from the company the last few years to what we expect to hear from them the next couple of years. I think when it comes to automation, they are pretty, far along the curve in terms of bringing automation both to their distribution centers and to the store. And it really is more about finding efficiencies and improving capacity in order to, continue to grow and continue to make more margin. And so that is something that we witnessed a couple of days ago with the company. And in essence, will allow them to become more efficient, allow them to do more of their e-commerce initiatives where they're seeing a lot of growth, which is their drive up business and their pickup business, and just allow them to get the goods to the consumer in a more efficient way.
All right, Kate, let's switch gears here and talk about a retailer that has clearly been struggling now for quite some time. That's Bed Bath & Beyond. And there was a movement today on reports that they want shareholders to approve a reverse stock split. Obviously, they're doing this in an attempt to avoid bankruptcy. Is there any scenario where that is still an option, where the retailer is going to be able to avoid bankruptcy? And do you see shareholders possibly approving this?
Yeah, so what we've written is that, they've definitely done a lot to just kind of, stay alive here. They've had a successful capital raise. They've had a couple of other announcements allowing them to, just have better relationships with their vendors, because really at the end of the day, what they need in order to survive is to have product in the stores so that when people come in, they buy it. And so, that is something that, we know the CEO is working very diligently on. We know there's been a lot of effort here to really start to stabilize the business. I do think that, having inventory and having the right inventory will help them. I think the question is just in this environment where you do have a consumer that's a little bit more thoughtful about their spending, exactly what it will yield for someone like Bed Bath & Beyond.
Yeah, certainly a lot of questions there. Kate McShane, always great to speak with you. Thanks so much for taking the time. We appreciate it. All right, well, coming up, Florida Governor Ron DeSantis calling Fed Chair Jay Powell a, quote, total and complete disaster. Find out why he may be taking aim at the Fed chair next.
Fed Chair Jerome Powell has been a, quote, total and complete disaster. Those are the words of Florida Governor Ron DeSantis, the presumed top challenger to Donald Trump for the Republican nomination, adding that, quote, people across the country are paying for it. Senior columnist Rick Newman here with more on the unlikely common ground for DeSantis and Elizabeth Warren. Politics is weird, man. Why is DeSantis criticizing Powell?
Yeah, I'm glad you pointed that out, Dave. This is actually a good tactic for Republicans on Main Street America. This reminds me of the old Tea Party attacks back when Ben Bernanke was chairman of the Fed. I mean, it's just easy to attack the Fed for something that goes wrong in the economy. To normal people, it seems like sort of a star chamber of elites, some kind of Illuminati in Washington, D.C. that just does all this, black magic and makes interest rates go up or down. Sometimes when Republicans take shots at the Fed, it's kind of a cheap shot. I'm not sure this is that much of a cheap shot because there are a number of mainstream economists, both Democrats and Republicans, who are pretty critical of the Fed for, first of all, pushing so much money into the economy during COVID, and then waiting so long to start raising rates, even when it seemed pretty clear we had inflation on the way. And as you pointed out, on the left, Elizabeth Warren, the Democratic senator from Massachusetts, she's been one of the Fed's biggest critics. I think her criticisms are a little bit different. She's saying that the Fed needs to just back off on interest rates because it's trying to put people out of work. But this is one of those sort of, time warp issues where if you go around to the extremes of the parties enough, you meet on the other side. And that seems to be where Ron DeSantis and Elizabeth Warren have met. So I'm not sure they're going to get together on this, but they are kind of saying the same thing.
The thing is about making Powell your boogeyman. Yes, 100% of our audience knows who he is. I would wager 75% of the American people who have no idea who Jerome Powell is or really what the Fed does. So that's an interesting enemy to take on. But I think the few days after the Trump indictment were going to be really fascinating, Rick, because I wanted to see if anyone would criticize former President Trump. And if you can't draw a distinction between yourself and a man who's been indicted for having an affair with a porn star and covered up the hush money payments to her, how in the world can you win a primary against him?
This is DeSantis' entire problem. I've seen some analysis sort of establishing four character types for Republicans running for the election in 2024. One is Trump himself, and then there are other candidates who are Trump-y, but they're not Trump, and that is DeSantis. So perhaps it's possible that one little crack here DeSantis is trying to create is he can say, well, everybody knows Jerome Powell, the Fed chair, has messed up the economy, and guess who appointed Jerome Powell the first time around? That was Donald Trump. Maybe he's going to go there at some point. I kind of agree with you. That doesn't seem like a real distinctive differentiation with Trump. Here's what I am guessing that some of the candidates are waiting for in the next couple of months. We know there are going to be more charges against Trump. They're probably going to be more serious and have heavier consequences than the ones we saw charged this week. In fact, in just a few weeks, there is going to be a civil case related to charges of rape and defamation against Trump. And I think we're going to have some upcoming cases that are going to make it easier for Republicans to criticize Trump because, what went on with the New York District Attorney getting lost in translation a little bit. It has to do with these payments that they bounced from one account to another, and that somehow turned into a crime. That's a little bit hazy. When you get into a rape allegation, not so hazy. So I don't think you're going to see, depending on the outcome of that trial, I'm not sure you're going to see so many Republicans rushing to defend Trump on that and some of the other stuff that's coming, possible voter fraud in Georgia, possible obstruction of justice with national security implications at the federal level.
All right, Rick, let's switch gears just a bit here. Another story coming out of D.C., or really from D.C. lawmakers, I should say. Apple CEO Tim Cook, Disney CEO Bob Iger, as well as other top executives from Google, Microsoft, are meeting with the White House, with the House Select Committee on the Chinese Communist Party. Questions there just about U.S.-China competition, clearly. Any idea, I guess, what could potentially, if anything, come out of these meetings?
That committee is new. That Select Committee on China didn't exist before 2023. And that is a committee that Republicans set up to give new scrutiny to what we ought to be doing with regard to China. Is it a competitor or a partner? And what kind of policies should we be putting in place? The important development here is that there's not much party split on attitudes toward China. That's one of the reasons when Biden took office, he did not repeal the Trump tariffs on Chinese imports. He kept those in place. And both parties basically want to show that they are tough on China. That has a lot to do with China stealing Western technology and trade secrets. There's a huge military buildup going on in China. We know that the current President Xi Jinping keeps saying they're going to go after Taiwan at some point. We don't know if that's just rhetoric or if he really means it, but it's getting serious with Taiwan, and Biden is putting some pretty tough new policies in place. And I guess this meeting is probably just to feel out business leaders and get their sense of what we can do without harming U.S. interests, because there still are a lot of business ties and trade ties between U.S. firms and consumers and Chinese firms and consumers. So we don't just want to tear up the entire relationship, because that would be very bad for us as well as for China. So I guess in the House, I'm just trying to get some ideas from these businesses that are operating in China and figure out what we can do without hurting ourselves.
China might be the only bipartisan issue before us today. Thank you, Rick. Appreciate that.
See you guys.
All right, coming up, with air travel seeing high demand ahead of Easter weekend, is now the time to start locking in those plans for Memorial Day and summer travel. Find out next.
Americans are eager to travel this holiday weekend, with airports screening more travelers. According to TSA, passenger volumes are tracking slightly above pre-pandemic levels. New data out from the travel app Hopper also showing that people are spending more this year. Round-trip domestic flights are averaging $267 here, up just about 5% from a year ago. Haley Berg, Hopper's lead economist, is tracking all of this data. Haley, it's good to see you here. So there's lots of talk that maybe that revenge travel is dead. Certainly doesn't seem like it from these numbers. What are you seeing just in terms of demand and really what that signals here for the summer travel season?
We have not seen the end of revenge travel. Demand remains incredibly high, especially for international trips. Spring break and those bucket list summer vacations this summer are increasingly going to be longer haul trips abroad, Europe, Asia, other top destinations. So have not seen the end of this post-pandemic surge in demand.
And what is your top domestic location, and why is it perhaps the face of revenge travel? What elements make it so?
Well, right now we're seeing demand to a number of top cities. For Easter and Passover weekend, for example, New York City is one of the most searched for destinations. It has not made the top of the list in the last couple of years, as well as warm weather destinations like Las Vegas, Orlando, Miami. They're offering leisure activities as well as warm weather and beach, which seems to be driving a lot of the demand right now.
And your top international location is Mexico. I find that interesting because the U.S. State Department, the Texas Department of Public Safety, each warned Americans to skip spring break vacations to Mexico, noting ongoing violence there and threats, kidnapping. Have you seen pullback in terms of travel to Mexico as related to this recent crime spree?
We haven't seen pullback related to the spree, but we are getting close to the end of the seasonal time where most Americans are headed to Mexico, Central America, and the Caribbean for spring break. So we will see a natural shift away from that region towards mostly Europe this summer, but have not seen yet an impact from the U.S. State Department's announcement. But hopefully we're seeing travelers be a little bit more careful on the trips they have already booked.
Haley, when it comes to fuel costs, obviously that's a huge thing here for airlines. The news earlier this week, OPEC Plus cutting some of its production. Jefferies was out with a note earlier just saying that that's going to be a challenge here for these airlines. How do you see that at all impacting airfare prices? Are they going to be even higher as a result?
Jet fuel is one of the major factors in airfare pricing. Typically about 15 to 30% of an airline's operating cost comes from jet fuel alone. International is really hot right now, and those international long-haul flights, they use a lot of fuel. They're very expensive to operate. If we continue to see jet fuel prices stay where they are or increase just a little bit, we may not see significant increases in price, but if we see a ramp up of jet fuel prices similar to what we saw at this time last year, we could be seeing higher prices probably on those longer haul international trips more than domestically.
All right, in our neck of the woods, the New York City area, congestion has been a major issue and a big concern going forward. The FAA even stepping in. What are the airlines and airports' solutions?
What we're seeing right now is still conservative network planning from airlines and airports alike. Today, domestic airlines are operating just about at or slightly above 2019 capacity levels, when they really should be well ahead of that if we track just demand. But they're remaining conservative in how many flights they're returning to the skies because of staffing challenges that are still persisting at airlines, airports, TSA, FAA alike, and so that they can provide quality of service. A major change we've seen in how airlines are network planning is bringing back fewer flights, but larger jets. It's probably a solution that we'll see carried for the next couple of years until many of the airline actual equipment, airplane equipment providers can catch up on their backlogs. But we are expecting to see continued conservative adding of capacity in the hopes that it will present those large crushes of cancellations and delays.
All right, Haley Berg, Hopper lead economist. Thanks so much. Well, coming up, while golf fans are watching Tiger Woods and some of the other big names compete at the Masters, investors are keeping a close eye on some key golf stocks. We'll tell you about them next.
Hello, friends. A tradition unlike any other is again underway, the Masters. While the world's best golfers covered the green jacket, we're taking a closer look at the green golf can bring you in terms of an investor's perspective. Golf fans on Wall Street closely monitoring companies like Topgolf, Callaway Brands, and Acushnet Holdings. Stevens Managing Director Daniel Imbro joins us now. Good to see you, sir. So let's start with Topgolf Callaway. You have an overweight rating and a price target of $34, implying some major upside. Why?
Yeah, it's a great question, and thanks for having me this afternoon, Dave. You know, I think when we think about the opportunity at Topgolf, it's one that presents, I think, two ways to win here. Within the core golf equipment business that this Callaway brand is known for, they've been demonstrating really a decade now of pretty stable share gains and really strong equipment rollout. That's been a very stable cash cow. What it's allowed them to do is continue investing in this acquisition of Topgolf and rolling out these units. You know, I think when they look at the unit economics here, they're rolling out really stable cash-on-cash returns. I think it's going to be a self-funding type growth story by the back half of this year. And when you look at the consolidated kind of growth you're going to get here, 10 to 12% top line, high teens EBITDA growth, I think you're getting a really attractive multiple for a really attractive kind of growth asset in consumer.
How significant a game changer was the merger with Topgolf, and talk about their growth you project moving forward?
Yeah, it's a great question. It definitely was transformative. It went from a mid-single digit, maybe high single type story to a company that's going to grow top line at least in the low double digits for the next probably 5 to 10 years. So material driver, and from an investor standpoint, it's become a major focus of conversation and really what the main investment is here going forward. So definitely has changed it. On the growth profile, we touched on it there. You know, double digit top line, they feel very good about. You're growing Topgolf units in the high teens for the next 3 to 4 years. Those returns, like I mentioned, have been very consistent with an opportunity for kind of organic growth after the first few years. And so, we project a double-digit top-line CAGR at least for 5 years here.
They've even inspired several competitors, even different types of private company chains. For one, Putt Shack, they have 5 locations, but 14 more on the way. And the Tiger Woods-backed Popstroke has 7 locations already. Do you see acquisitions continuing to be part of the playbook for Callaway Topgolf?
Yeah, it's a great question. I do think M&A over time will be a part of the growth story here. This has been something that CEO Chip Brewer has really done for the last 7 or 8 years at Callaway, buying some apparel brands years ago, and then more recently Topgolf. I'm not sure kind of where the M&A will look like. Last year, Topgolf Callaway brands made an equity investment in a company called 5-Iron. That is an indoor kind of driving simulator type concept. So obviously they've had an interest there. But I do think M&A will likely go forward. And I think the competitors you speak to just speak to the durability that we're seeing in the golf industry. There's been a revival of the game. Really, this started pre-COVID. I think there's a misconception that the game was kind of declining into COVID. We had seen a couple of years of growth into COVID. COVID fueled that. And I think these other concepts that are growing just speak to the resilience and kind of the positive outlooks for the industry over the coming years.
How significant did COVID, though, impact the growth of the game?
Materially. I mean, it would, definitely a big uptick in things like participation. But I think when we look at the companies here, what we like about them is, I would argue a lot of those transitory golfers during COVID, frankly, maybe didn't show up on the P&Ls as much as some investors may think for these companies. Golf as an industry historically is very top heavy. The top 15% of golfers are almost 70% of dollars spent each year. So it's a very enthusiast driven game. And so what I think is encouraging is what we're seeing is some of those transitory golfers, while we're losing some of them, some of them are converting into dedicated players, spending more per year. And I think that's going to help grow the overall pie. So it's been a nice, I think, ongoing tailwind.
Want to touch on the other I mentioned, Acushnet Holdings. Who are they? Why the price target and rating?
Yeah, it's a great question. So Acushnet, many of you likely know their brands better, Titleist and FootJoy being their largest at the majority of their product portfolio. They're an industry leader in categories like golf balls and consumables like shoes and gloves. I think for us, when we look at the stock here, just the valuation for the growth prospects, I think it's probably a closer to mid-single digit type grower in a normal year, maybe gain a little bit of share, but more industry type growth. And I think the valuation's more full there versus something like a Topgolf Callaway brand.
All right, well, there's the good news. The bad news is Tiger 2 over, and Rory McIlroy is trying to complete the career Grand Slam, struggling as well. There goes my bets. Daniel Imbro, good to see you. Thanks, my friend. Enjoy the Masters. Sean?
Thanks so much. You as well.
All right, ousted Marvel Entertainment Chairman Ike Perlmutter telling the Wall Street Journal that he was fired, not laid off, by the company last week. Yahoo Finance senior reporter Ali Canal joining us now with more on that. And Ali, also some interesting commentary here with what he had told Florida Governor Ron DeSantis.
Yeah, Shauna, a very fiery interview from Perlmutter. And like you said, there were quite a few headlines to come out of it. One, as you mentioned, is that Perlmutter insists he was fired due to the aggressive cost cuts that Disney has been undergoing, eliminating 7,000 jobs by this summer in order to slash $5.5 billion in costs. Now, that restructuring is something that Perlmutter actually pushed for during his time at the company. He said, quote, "I have no doubt that my termination was based on fundamental differences in business between my thinking and Disney leadership because I care about return on investment." Now, he had repeatedly expressed concerns over how much the company spent and the excessive spending, particularly around Marvel film productions. But you did mention his comments about Governor Ron DeSantis and that ongoing battle with Disney that they're currently in right now. Perlmutter saying that he called the governor last year saying, quote, "Ron, you're right. Disney doesn't have the right to get involved with politics. And I'm the largest individual shareholder." Now, Perlmutter owns a reported 30 million shares of the company. That equates to roughly $3 billion. So he's had this long and storied history with Disney. But CEO Bob Iger has been committed to this restructuring. He's defended the company's past decisions. And in that process, he has eliminated quite a few prominent positions, shifted leadership roles. And I wouldn't be surprised if there were some more changes to come.
Very interesting exit on his behalf, though. Elsewhere, moviegoers alley treated to a pair of highly anticipated releases. We had Air movie and the Super Mario Brothers movie. What sort of numbers are we expecting at the box office?
Well, Dave, I know you're very pumped about this Air movie. I am too. The trailer looks amazing. And you know what? You're in some good company here because 98% audience score on Rotten Tomatoes, 96% critic score on opening day. The movie did only nab 3.2 million, but I do expect those numbers to tick higher over the weekend. The industry estimate is projecting 10.6 million over the traditional weekend window, 16 to 18 million in its first 5 days of release. Now, this is an Amazon film, so this likely will be on Prime Video at some point. It's not clear how long that box office window will be, but if you want to talk about a very strong opener, that's the Super Mario Brothers movie, smashing expectations, nearly 32 million on opening day. That performance actually caused an upward revision for those opening weekend estimates to 92 million over the weekend and 141 million over the 5-day. But we've talked about how successful the March box office has been, and this will just kind of take us towards the summer. Well, hopefully we'll have a strong blockbuster season as well.
All right, Allie, and then finally, another quick story here. Netflix, I know you wrote up a piece on a Jefferies note that was out today. We will be getting earnings results from Netflix in just about 2 weeks. What can we expect there?
Yeah, well, Jeffrey's saying that earnings, it's not really going to be the main story here for Netflix. Rather, the bank is focusing more on that password sharing crackdown, the recently launched ad-supported tier. Jeffrey's saying that those two revenue drivers will be a reacceleration of growth that we'll see towards the end of this year and well into 2024. They said that we're still in the early days of both of those growth initiatives, but any commentary that we'll get on the earnings call in 2 weeks on conversion, churn, and/or adoption will be very important. In the meantime, Jefferies did say that investors will likely have to battle a lot of noise, especially in the second quarter, but they are encouraging investors to buy the dip there, saying that these are longer-term catalysts and any immediate knee-jerk reaction is going to settle over the long term. So that's going to be a very interesting earnings report, and we'll be tracking it very closely for any more specific commentary, particularly about password sharing and how the ad tier is doing.
Yeah, can't wait for that. All right, Allie Canal, thanks so much. Appreciate that. Enjoy the weekend. All right, coming up, from key economic data to earnings, investors have a lot to prepare for over the next week. See what will move markets next.
We think about some of these surprises that we could potentially still see in the second quarter of this year and even further out into the rest of the year.
It's the time of year some look out for an April surprise.
The one that I'm still looking at is what happens geopolitically, what happens in Ukraine. And then a derivative of that is what continues to happen with US-China relations.
Thus far, the surprises have really been the resiliency of the labor market. But we do have a backdrop now of a banking crisis that just started weeks ago. The surprise going forward in the next few quarters could be that the economy drops off more than anticipated.
It is our belief that focus would shift to fundamentals, shift to earnings. And on that front, we're already seeing signs of margins compression, earnings contracting for the first time since late 2020.
I'm incredibly boring. I think cash is queen, but I do think it'll change at some point. So I'm looking out for Q2 earnings. I think they're going to be weaker than expected.
At the end of the day, if the earnings are not there, then we could have more problems for the equity market in front of us.
There's been certainly no shortage of surprises in the markets really over the last couple of years, but even just the last several weeks.
Here's what I think that are the biggest risks that I'm concerned about. The Fed's going to keep raising rates a little bit, maybe a couple more times. I think reality is going to set in that the earnings revisions aren't enough. But the real thing that I think is going to be a problem is if we see a reversal of inflation coming down.
It's closing time here at Yahoo Finance. Let's get you caught up with some of the biggest stories that we are watching for the day ahead. The stock markets may be closed, but we will still be getting the March jobs report Friday morning. Economists are predicting the U.S. added 230,000 jobs last month and that the unemployment rate will be unchanged at 3.6%. Be sure to watch Yahoo Finance. We will be live to bring you those numbers as soon as they break.
Now let's turn to next week. On Wednesday, we get the latest read on inflation. Economists expect March's consumer price index report to show prices increased by 5.1% year over year. We'll be watching closely the shelter component of the report, which has remained stubbornly high over the last few months.
And finally, the return of earnings season. Next Friday, big banks will kick things off with JP Morgan, Citigroup, and Wells Fargo all reporting their first quarter results. Given the chaos with regional banks over the last several weeks, we will be listening closely to those earnings calls to hear what the CEOs are saying about the health of the banking sector.
Okay, that'll do it for us for Yahoo Finance Live. Be sure to come back Monday at 3 o'clock, but this young lady will be here at
8:25 tomorrow morning.
On Friday for the jobs report. Pivotal news coming. Enjoy the weekend as far as I'm concerned.
I'll be here tomorrow.